My view is essentially that we're going to have a faster money supply increase than consensus probably estimates at the moment. We've already gone from roughly 15 trillion to over 18 trillion just year to date. The way that they kind of try to go out of it is by, instead of decreasing debt, they radically increase the money supply from that point. So if you look at the monetary base from that period, it just skyrockets, it goes vertical. So my point now is that the current period, the 2010s really mimicked a lot of what we saw in the 1930s, where we had this rapid increase in the monetary base, but it wasn't a very outright inflationary environment because we had so much private deleveraging. So we had a private debt bubble. We had the housing sector specifically deleverage a bit. But then in the 2020s, it looks like we're kind of more closely mirroring the 1940s, where we have a federal debt bubble. So we started this decade at over 100% of GDP federal debt. Now we're already over 120%. We're running a 20% plus deficit this year as a percentage of GDP. And the Federal Reserve's once again talking about yield curve control, and they are the primary buyer of treasuries. So it's eerie how kind of similar these two periods have been. So if you look back to the 1930s and 1940s, the Great Depression, of course, started with the 1929 stock market crash, and then the first several years of the 1930s were this very deflationary crush. And that's because we started that decade with a very high private debt level relative to GDP. So federal debt was pretty low because the government was pretty lean back then, but we had a very large private debt bubble that had built up throughout the 20s. And during the first few years of the 1930s, we had major bank failures. So we actually had a major decline in the broad money supply, which doesn't happen these days. It just goes up at different rates. It never really goes down. But back then they had they lost about a third of their broad money supply because so many banks failed. And so even though there was deleveraging and defaults, debt as a percentage of GDP kept going up. And they eventually, as most viewers probably know, they devalued the dollar compared to the gold peg it was on. So they decreased it from, about 1/20th of an ounce to 1/35th of an ounce of gold per dollar. And that also, they printed tons of money. They did all these infrastructure works. They did all these new entitlement programs that we know today. The way that they kind of tried to go out of it is by, instead of decreasing debt, they radically increased the money supply from that point. So if you look at the monetary base from that period, it just skyrockets. It goes vertical. So it's not like a gradual change. It's just like a sharp transition to a new era of how they're doing things. And people might think that's inflationary, right? So, and it was to a certain extent. So we went from deep deflation, we had negative 10% inflation, right? And then when they devalued the dollar, it shot up to maybe 5% inflation, right? So we didn't have high levels of inflation. We had a more reflationary environment. But basically, there's so much debt and deleveraging in the system and destruction of capital and destruction of wealth that even though they increased the money supply pretty significantly, we didn't really experience high inflation for that decade. So during the 1940s, there were really sharp periods of inflation that briefly even exceeded what we saw later in the 1970s. So we had double-digit inflation in I believe 1942 and 1947. We had these big spikes of inflation, but they still held the treasury yield at 2.5% or below. And as a result, if you look over the course of that decade, we had this continued rapid increase in the money supply. We had a more inflationary, fiscal-heavy, environment. But because they locked yields so low, treasury yields, even though they made money nominally, they lost money on a real basis. So they underperformed inflation. They underperformed things like silver, real estate, stocks, and so treasury investors lost money on a real basis throughout that decade. The federal government and the Fed, they can't necessarily impact GDP too much because that's most of the private economy transacting. But the thing that they control more is the money supply. So in addition to money supply being created by commercial lending, the federal government, as we saw in this period, they can do things like helicopter checks, extended unemployment benefits. They haven't done it yet, but they could do a big infrastructure bill. Whatever they could do tax cuts like we saw in 2017, and they could do more tax cuts. So there are various kind of right-leaning or left-leaning things they can do that essentially gives more money back to the public, but that's not funded by it's not funded by taxes. It's not funded by people lending. It's funded mainly by them issuing treasuries and the Federal Reserve creating dollars to buy those treasuries. From their point of view, they have an inflation target of symmetric 2%, right? So, and they if they run cold, if they run at say 1% for a while, they're happy to go up to 2.5 to 3% to kind of quote make up for the fact that they ran low for a couple years. So from their point of view, if they can achieve say 3% inflation while doing yield curve control and capping yields at 1.5%, that's kind of how they probably view a way of managing debt levels, especially for the federal debt. The money supply is the denominator for the velocity calculation. So if you compare GDP to money supply, if you're increasing the money supply very quickly, but the GDP is not increasing as fast, then by definition you're going to get lower velocity. And that's because the amount of money supply that they're doing doesn't necessarily translate into higher productivity and higher kind of core growth. So there's a couple different factors into play there. One is that over the past couple decades, we've had pretty significant wealth concentration. So wealth concentrates, in the top 10% or so, and then especially in the top 1%. So rather than a lot of that money kind of getting around to the broader economy and being spending frequently, it's more hoarded, right? Because I always say as a thought experiment, if you take $1 trillion and distribute it, you give everyone several $1,000 checks to everyone, you'd have a lot of spending at that point, because people that don't have a lot of money would be getting this like capital injection. A lot of that would be spent, right? But if you say take that same amount of money and you give a few billionaires each an extra billion, it's not going to change their spending habits, right? They're just going to put it into investments. They're going to save it. Even down just people in the top 5%, top 10%, if you get a capital injection, you don't go out and necessarily spend it. You just kind of save it. You put it in your 401k. You do all this, hoarding. And so because we've had wealth concentration and because we've had other factors like aging demographics, this money supply is growing faster than GDP. So we're by definition, the way that the calculation works, we're seeing much lower velocity. And that's a big reason why we haven't seen broad consumer price inflation, because that velocity is not really there. In this period, because we have so much aggressive fiscal spending that's being monetized by QE, a lot of that is spilling over into the broader economy. So in the near term, it's not sharply inflationary. It's if anything, we have deflation in discretionary goods, and then some inflation in the more essential areas due to supply chain disruptions and such. But if this continues over the several more years, which is likely considering with people out of work, they're not all going to go back quickly, so we're going to have tax decreases, we're going to have extended spending levels. So it took many years to somewhat normalize after the previous crisis, and this one by most measures is far larger. My view is essentially that we're going to have a faster money supply increase than consensus probably estimates at the moment. We've already gone from roughly 15 trillion to over 18 trillion just year to date. And in the years ahead, I think this is going to continue going up by the trillions because most of this QE and most of this federal spending is spilling out into broader economy, not necessarily equally, but it's getting out there. So if you combine supply disruptions, deglobalization with this rapid increase of debt monetization and fiscal spending, we could be up for a more inflationary environment in the 2020s, similar to what we saw in the 1940s. The money supply is the denominator for the velocity calculation. So if you compare GDP to money supply, if you're increasing the money supply very quickly, but the GDP is not increasing as fast, then by definition you're going to get lower velocity. And that's because the amount of money supply that they're doing doesn't necessarily translate into higher productivity and higher kind of core growth. We had like negative 10% inflation, right? And then when they devalued the dollar, it shot up to maybe 5% inflation, right? So we didn't have high levels of inflation. We had a more reflationary environment. But basically, there's so much debt and deleveraging in the system and destruction of capital and destruction of wealth that even though they increased the money supply pretty significantly, we didn't really experience high inflation for that decade. The way that they kind of tried to go out of it is by, instead of decreasing debt, they radically increased the money supply from that point. So if you look at the monetary base from that period, it just skyrockets, it goes vertical.